There are moments in finance that make headlines for weeks. A major bank collapses. The stock market plunges. The Federal Reserve surprises everyone with an emergency announcement. Those stories dominate television, flood social media, and become impossible to ignore. But the decisions that often have the biggest impact on your financial future rarely arrive with flashing red banners. They appear quietly, buried inside government filings, regulatory updates, and policy proposals that most Americans will never read. By the time the public realizes what changed, the rules have already been rewritten. And that is exactly why today's story deserves your attention. Over the past few years, Americans have watched one financial shock after another. Inflation climbed to levels many people never thought they would see again. Interest rates rose faster than they had in decades. Regional banks that once appeared perfectly stable suddenly found themselves fighting for survival. Some disappeared almost overnight. Others survived only because regulators stepped in before panic spread across the financial system. During those moments, millions of Americans asked the same question: is my money actually safe? For most people, the answer seemed simple. As long as the bank displayed those familiar FDIC letters, everything would be fine. That small logo has become one of the most trusted symbols in American finance. It represents stability, security, and confidence. It tells depositors that even if something goes wrong, their insured deposits are protected. That belief has helped keep confidence in the banking system alive for generations. But here is the question very few people ever stop to ask: what happens when the rules behind that protection begin changing? Quietly, while almost nobody is paying attention, that question has become much more important than many people realize. Because while Americans have been focused on inflation, housing prices, and the cost of living, financial regulators have been making a series of adjustments that could reshape how banks operate. In the years ahead, none of these changes sound dramatic by themselves. In fact, many of them appear perfectly reasonable at first glance. Regulators describe them as modernization. Banks describe them as necessary reforms. Industry experts call them technical updates. But history teaches us something interesting. Financial crises rarely begin with one enormous mistake. They usually begin with dozens of small decisions that seem harmless until they all collide at the worst possible moment. Think back to the financial crisis of 2008. Before everything unraveled, very few Americans believed the banking system was in danger. Banks were reporting profits. Investors were optimistic. Home prices kept rising. Experts appeared on television saying the financial system was fundamentally strong. Then confidence disappeared almost overnight. Institutions that looked healthy suddenly faced enormous losses. Markets froze. Credit dried up. Families watched retirement savings shrink while businesses struggled to survive. Looking back, the warning signs had been there all along. They simply did not receive enough attention while conditions still looked calm. Today, the banking system faces a completely different set of challenges. But uncertainty has not disappeared. Commercial real estate remains under pressure. Businesses continue borrowing at higher interest rates than they became accustomed to during the previous decade. Consumers are carrying more debt while household budgets are squeezed by higher prices. Banks themselves are adapting to rapid technological change, cybersecurity risks, and growing competition from digital financial companies. None of these developments guarantee another banking crisis, but they do create an environment where strong oversight becomes even more important. That is why recent regulatory decisions deserve careful attention. When agencies responsible for supervising banks begin adjusting long-standing rules, every depositor should understand what those changes actually mean. Not because panic is appropriate, but because informed decisions are always better than emotional reactions. Unfortunately, most regulatory announcements are written in language that ordinary people rarely understand. Technical terms, legal references, and complicated Financial formulas make it easy to overlook changes that could eventually affect millions of depositors. Imagine owning a house protected by a strong insurance policy. Every year you pay your premiums believing that if disaster strikes, your family will be protected. Then one day the insurance company quietly updates the policy. They change several definitions, adjust a few requirements, and modify how certain claims will be handled. None of those changes immediately damage your house. Nothing feels different the next morning. But if a disaster eventually occurs, those small revisions suddenly become incredibly important. Banking regulations work in much the same way. The real impact often appears only when the financial system experiences genuine stress. One of the biggest misconceptions about banks is that safety depends entirely on how much money they earn. Profitability certainly matters, but confidence matters even more. Banking is built on trust. Depositors trust banks to safeguard their money. Banks trust borrowers to repay loans. Investors trust financial statements. Regulators trust institutions to manage risk responsibly. Once trust begins weakening, problems can spread much faster than most people expect. Modern technology has accelerated this process dramatically. A rumor posted online can travel across the country within minutes. Billions of dollars can leave a bank through mobile apps before executives even finish their first emergency meeting. We witnessed how quickly confidence can disappear during the regional banking turmoil only a few years ago. Institutions that had operated successfully for decades suddenly experienced enormous deposit withdrawals within hours. Customers no longer needed to stand outside bank branches waiting in line. They simply opened an app, pressed a few buttons, and transferred their money elsewhere. Banking has become faster than ever before. Unfortunately, financial panic has become faster too. That reality forces regulators to think differently about how they supervise banks and how they prepare for unexpected shocks. Supporters of recent regulatory reforms argue that banks should not carry unnecessary burdens when the financial system appears stable. They believe reducing certain costs allows banks to provide more loans, support businesses, and stimulate economic growth. Those are reasonable goals. A healthy economy depends on healthy banks. Excessive regulation can slow lending, reduce investment, and make financial services more expensive for consumers. No serious observer wants unnecessary rules simply for the sake of having more rules. But there is another side to that conversation. Regulations exist because history repeatedly shows what happens when risk grows faster than oversight. Financial safeguards often seem excessive during good times because their true value only becomes visible during bad times. Seatbelts feel unnecessary until an accident occurs. Fire extinguishers appear useless until smoke fills the room. Deposit insurance, capital requirements, liquidity standards, and supervisory examinations serve a similar purpose inside the banking system. They are designed not for ordinary days, but for extraordinary ones. The challenge facing regulators today is finding the balance between encouraging growth and preserving stability. Lean too heavily toward regulation, and economic activity may slow. Lean too heavily toward deregulation, and financial vulnerabilities may quietly accumulate beneath the surface. Finding that balance has never been easy, especially during periods of economic uncertainty, like the one America is experiencing today. So as you hear about new banking proposals, changing regulations, or adjustments to long-standing financial rules, remember something important. The biggest financial stories are not always the loudest. Sometimes the most important developments happen quietly, long before they become front-page news. Understanding those developments does not mean expecting disaster. It means recognizing that protecting your financial future begins with paying attention before everyone else does. Because by the time the headlines finally arrive, the decisions shaping tomorrow's financial system have often already been made. Now, let us take this conversation one step further, because understanding that regulations are changing is only part of the story. The much bigger question is this: why are these changes happening now? Timing matters in finance, sometimes even more than the policy itself. A rule that makes perfect sense during a period of strong economic growth can become far more controversial during a period of uncertainty, and that is exactly why so many financial analysts are paying close attention to the direction regulators appear to be moving. Over the past several years, the American economy has been walking a very narrow path. Inflation may have cooled from its highest levels, but it continues to place pressure on household budgets. Interest rates remain significantly higher than they were only a few years ago, making mortgages, business loans, and credit cards much more expensive. Commercial real estate continues facing serious challenges as office buildings across the country struggle with lower occupancy rates. Banks with large exposure to commercial property are still navigating risks that may take years to fully unfold. None of this automatically means a financial crisis is coming, but it does mean the environment remains far more fragile than many people realize. This is why confidence has become one of the most valuable assets inside the financial system. Money itself is important, but confidence determines whether that money stays where it is. The moment people begin questioning the strength of a bank, withdrawals can accelerate with incredible speed. Modern banking technology has completely changed the way financial stress spreads. Years ago, customers physically stood outside branches waiting to withdraw cash. Today, billions of dollars can leave an institution through smartphones in only a few hours. That means regulators are no longer preparing for slow-moving banking problems. They are preparing for events that can unfold faster than almost anyone imagined just a decade ago. Because of that reality, regulators constantly evaluate whether banks are prepared for unexpected shocks. They examine liquidity, capital levels, operational systems, cybersecurity, and recovery planning. From one perspective, these reviews are reassuring because they demonstrate that government agencies are actively monitoring potential risks. But from another perspective, they remind us that financial stability can never be taken for granted. Every new safeguard exists because something similar went wrong in the past. Banking regulations are often written in response to yesterday's mistakes while trying to prevent tomorrow's crisis. One lesson history teaches repeatedly is that financial systems rarely collapse because of one enormous problem. They weaken gradually. A little more risk here, slightly less oversight there. Greater confidence during good times encourages more borrowing, more lending, and more optimism. Eventually, the system begins assuming that difficult conditions belong only to the past. That is precisely when caution becomes most valuable. Markets have a habit of rewarding confidence until the moment they suddenly reward preparation instead. For ordinary Americans, this conversation should never become an excuse for fear. Fear has caused countless investors and depositors to make poor financial decisions throughout history. Panic selling, emotional withdrawals, and reacting to rumors have often created more damage than the underlying events themselves. The goal is not to become frightened. The goal is to become informed. Financial literacy has always been one of the strongest forms of protection available to any family, and it costs far less than recovering from avoidable mistakes. That begins with understanding exactly how your own accounts are protected. Many Americans know that deposit insurance exists, but surprisingly few understand its limits or how different ownership categories work. Some families unintentionally keep balances far above insured limits in a single institution simply because they have never reviewed their accounts. Others assume every financial product offered by a bank carries identical protection, even though that is not always the case. Spending one afternoon reviewing your accounts may never feel urgent, but small actions taken during calm periods often become incredibly valuable during uncertain ones. Another principle that successful investors have followed for generations is diversification. Diversification is not only about stocks and bonds. It is about avoiding unnecessary dependence on any single source of financial security. Strong financial planning recognizes that unexpected events can occur even inside well-regulated systems. Building emergency savings, maintaining healthy cash flow, understanding your insurance coverage, and reviewing important financial documents are habits that strengthen resilience, regardless of what the economy does next. There is also a broader lesson hiding beneath this entire discussion. The American banking system remains one of the strongest and most sophisticated financial systems in the world. It has survived recessions, market crashes, wars, inflation, technological revolutions, and global financial crises. That resilience should not be ignored. At the same time, strength does not eliminate the need for vigilance. Every generation believes its financial challenges are unique, yet history repeatedly reminds us that confidence and caution must always exist together. As we move further into 2026, debates about inflation, government spending, interest rates, and banking regulation will almost certainly continue. Politicians will argue, economists will disagree, banks will defend their positions, regulators will explain their decisions. But regardless of which side ultimately proves correct, one responsibility will always remain with individual Americans. No government agency cares about your financial future as much as you do. No institution will ever monitor your savings with the same attention that you can. That is why staying informed matters so much. Reading beyond the headlines, asking thoughtful questions, and understanding how major financial decisions affect ordinary depositors are not activities reserved for economists. They are habits that help families protect the wealth they have spent years building. Financial security is rarely created by predicting every crisis correctly. More often, it comes from consistently making careful decisions long before uncertainty arrives. So, here is the most important takeaway from everything we have discussed today. Quiet regulatory changes deserve attention not because they guarantee trouble, but because they shape the financial system that millions of Americans rely upon every single day. Understanding those changes allows you to replace uncertainty with knowledge and speculation with preparation. And in a world where economic conditions can change faster than ever before, preparation has become one of the most valuable financial assets anyone can own. The strongest financial decisions are rarely made during moments of panic. They are made during moments exactly like this, when the headlines are quiet, when emotions are calm, and when people still have time to think clearly. That opportunity exists today, whether the coming years bring stability or new challenges. The families who remain informed, disciplined, and prepared will always stand in a stronger position than those who assume someone else is watching the system for them. Because, at the end of the day, protecting your financial future does not begin with reacting to the next crisis. It begins with understanding the quiet decisions being made long before that crisis ever has a chance to appear.